So in this video, we're going to be going over how much home you can afford using an FHA loan. And we'll go over why even use an FHA loan, the benefits of that. We'll go over the formulas that lenders use to qualify you. We'll touch on different real life scenarios using different income amounts. And then at the end, we'll go over how to not be house poor, because the amount that you qualify for might not be the amount that you can actually afford. So let's get into it. So why use an FHA loan? So FHA loan is the most lenient loan program out there besides VA. VA, you have to be either active military or a veteran to use, but pretty much with an FHA loan, anyone can qualify for it because they allow a lot lower credit score. They allow you to go down to a 580 credit score. Now, here's the thing, with a 580 credit score, you're gonna need a lot higher down payment, and you're also gonna get killed on the rate and the fees. So really, the next benchmark is gonna be a 620 score, because with this 620, you're gonna get a lot better interest rate, and you only need 3.5% for a down payment. Now, also with an FHA loan, you can qualify with having more monthly debt versus any other loan product. So before I go into the comparison of other loan products, if you're planning to buy a house, I put out videos every single week. Hit the subscribe button so you get notified every time I put out a video. Now let's go over the comparison. Okay, so here's how much total debt to income ratios each loan program will allow. So on an FHA loan, they'll allow 50% of your monthly income to go towards your total monthly debt. Now on a conventional loan, they allow 50%. And on a USDA loan, they allow 45% of your monthly income to go towards your monthly total debt. And VA, they allow 50 to 60% of your monthly income to go towards your monthly debt. Now let's go over what they consider as far as monthly debt. Okay, so here's what lenders consider as debt. They look at your car payments, credit card bills, student loans, alimony, child support, IRS, payments, future mortgage payments, and also any personal loans or installment loans. And it's important to note that they look at really the monthly debt and not the actual total debt. Now, here's what they don't consider as debt. They don't consider your rent payment. They don't consider cell phone bills, utilities, groceries, any car or health insurance. So that is why just because a lender is qualifying you for a certain amount doesn't necessarily mean that you need to borrow that amount as far as what you can afford, because they are not taking a lot of your actual monthly debt into consideration. Now let's go over how the banks qualify you. Okay, so here's the formula that lenders use to qualify you. So they look at your DTI, which is your debt to income ratio. So they take your monthly debt and divide it by your monthly income, the gross amount, not your net amount. And then they multiply it by 100 to get the percentage. So let's say that you have $5,000 of total monthly debt and you make $10,000 of monthly income. So you divide your debt divided by your monthly income, and then you take, which would be 0.5 in this scenario, you multiply it by 100, and that gives you 50%. So this shows that 50% of your income is going towards your monthly debt. And on an FHA loan, you can go up to 56%. Now let's go into some real life scenarios. Okay, so let's look at $50,000 of yearly income. Here's how the bank calculates how much home you can afford. We take your monthly income. Now this is pre-tax, not after tax. We multiply it, in this scenario, 56%. This is how much FHA will allow you. And then we take, this is how much your leftover flowing income. Then we take the amount of income left over, we subtract it by all of your monthly debt added up. In this scenario, we're using $1,000 of monthly debt. And then this is how much mortgage payment you'll be able to qualify for. And this is principal, interest, taxes, everything out the door. So this amount of mortgage payment with about a 6% interest rate, you could qualify anywhere from around $150 to about $175 for a house. So let's look at a higher income amount. So let's go over $75,000 of yearly income. So your monthly income pre-tax is going to be $6,250. We multiply that by 56% per FHA guideline, and then we have $3,500 of monthly income to use. So we take the monthly income, we subtract any monthly debt that you have, and in this scenario, you can qualify for a payment of $2,500. And this includes, again, everything out the door, taxes, insurance, and mortgage insurance as well. So a $2,500 mortgage payment is gonna be equal, with about a 6% rate, it's gonna be equal to a home price of anywhere from $295,000 to about $300,000 for a home price. Now let's look at a higher income amount. Okay, so if you make $100,000 a year, your monthly income pre-tax is going to be around $8,300 a month. Now you multiply that by 56%, which is the FHA guideline, we're able to use $4,600 of your monthly income. So we take that amount of monthly income, we subtract any of your monthly debt. In this scenario, we're using $1,000 a monthly debt, and that gives you $3,600 a month. That is the maximum mortgage payment that you can qualify for. This is including taxes, insurance, everything out the door. And this payment with a 6% interest rate is gonna equal to a home price of around $450,000. Okay, so here's the thing. We just went over how much home you can qualify for. Now on the flip side, just because the bank qualifies you for a certain amount doesn't mean it's a smart financial move for you to take that entire amount. Because you do not want to be house poor, and you hear that term all the time. And what that basically means is you don't want to stretch yourself too thin. And here's the thing. The lenders are not financial advisors for you. They work for the banks, and the banks, at the end of the day, they want to mitigate their risk. That's why they have their certain set of guidelines, and you know your situation best. So let's go over some budgeting tips so you can keep the home. We're going to go over the 28% rule. And this means that 28% of your monthly income should be dedicated towards your housing. Anything more, you're stretching yourself too thin, and it's going to be hard to save for retirement, emergency funds, and things happen to the house as well. So that's where they came up with 28% of your income towards your housing payment is really the sweet spot. Okay, so FHA does allow you to have a cosigner, and the benefit of having a cosigner is it will increase how much your buying power is. You'll be able to get qualified for because you're able to combine your incomes, and the more income that you have, the more you can qualify for. But the thing is we must include their monthly debt as well. So the perfect cosigner is one that doesn't have a lot of monthly debt, that brings in a good amount of income. Now, as far as credit score, the same qualifications apply to them. You need at least a 620 credit score. Now, if we can go a little bit lower to 580, but you're gonna need a lot higher down payment, you're gonna get killed on the rate and the fees. And this can be a non-occupant co-borrower, which means that they do not have to live in the home as long as one person lives in the home and it's their primary residence. Now, it's important to note that the cosigner, they're gonna have 50% ownership of the house because they're on the mortgage. So make sure that you know your cosigner really well and you choose wisely. Okay, so here's the downside of using an FHA loan. So it's really the mortgage insurance, because you're having to pay for it in two ways. One, you're having to pay for it in an upfront fee that's actually financed into the loan. And two, you pay for it on a monthly base. So when you're putting 3.5% down, that monthly mortgage insurance stays for the life of the loan. Whereas on a conventional loan, when you're putting less than 20% down, the mortgage insurance actually drops off once you pay down your loan to a certain amount. On FHA, again, it stays for the life of the loan. Okay, so here's an overall good strategy for you to use an FHA loan. So you want to use this loan to get into the house. Then once you're in the house, work on your credit or whatever needs to be done. Then refinance to a conventional loan so that you can drop the mortgage insurance and you can get a cheaper mortgage payment. Okay, so here's how to get started to get qualified using an FHA loan. So before you even talk to a lender, you want to first check your credit score and see if it's 620 or above. If it's not, if it's below 620, then, and just note that you'll need a large down payment and you'll get killed on the rate and fees. So really that benchmark is 620. Then start gathering your docs. So if you're an employee, you work for a company, you'll need your last 2 years of W-2s. Now, FHA, you need a 2-year work history. This doesn't mean that you have to work in the same line of field for 2 years. You don't even have to be in the same job for the last 2 years. You just need to have been employed. And then you'll also need the last 30 days of your pay stubs. Now, if you're self-employed, you own a business, or you're a contractor, you're 1099, they will need your last 2 years of filed tax returns, and they look at your taxable income, how much you're claiming on the actual tax returns. So as far as the down payment, for an FHA loan, the minimum down payment is 3.5%. Now you can use down payment assistant programs. They will lend you the 3.5%, but here's the thing, it's never free money. You either have to pay it back on a monthly base, or you have to pay it back when you either sell or refinance the house. And a lot of people don't understand that there's a lot stricter guidelines. You need to have a lot higher credit score than what just the base FHA will allow. And also there are fees, and sometimes you get a higher interest rate as well. So if you don't utilize down payment assistance, then you can either use money from your 401k, your IRA, any retirement account. You can also get a gift from a family member. The main two things that FHA does not allow is they don't want to see the down payment as a personal loan, and two, they don't want you to use cash for this because they can't source it. And the banks will actually ask you for the last 2 months of your bank statements to make sure there's no large deposits in there. Now, as far as closing costs are on top of the down payment, and basically what they are is just the cost of transferring ownership from the seller to the buyer. So typically it costs anywhere from 3 to 4%, and this cost includes title fees, where they are making sure that you're not buying a house that has liens or judgment attached to it. They're making sure that you're buying the house free and clear. Also, there are state and government taxes. Also, it's including your escrow account, which is paying a portion of your property taxes and your homeowner's insurance up front. And what's cool about an FHA loan is the seller can actually contribute and pay for these closing costs. And they allow up to 6% for the seller to pay. So this is a great benefit of using an FHA loan. Okay, so here's how to apply with an FHA loan. So FHA does not directly lend to the public, so you cannot apply directly with them. You'll either need to apply with a bank, direct lender, or a mortgage broker. And really the difference between all three, a bank and direct lender, pretty much the same thing. You're stuck with whatever loan programs they provide, whatever interest rate they provide, and if for some reason your loan gets denied, then you have to start the whole process somewhere else, get your credit repulled, do another loan application. Now, with a mortgage broker, what's nice about them is with one credit pull and with one mortgage application, they can shop the rate for you among 100 different banks, and they do the shopping for you, pretty much the work for you. So I'm a mortgage broker. If you want my help, if you want to know how much buying power you have, click on the link in my description, book a call with me. I'll help you out, and I'll see you on the next one.